Go ask them how much business they do that is not Hyperliquid, and you will be shocked. If money is not moving, it's not useful, right? Like money is really only valuable when it has velocity.
Because it looks like a lending protocol. And then we say it's debt servicing, and you say, what is that? And we say, well, it can be
I want you to double click a little more. Why leverage lending and why does it matter?
Welcome to the Deco podcast, where we bring you stories from founders and investors in Web3. Before we get started, this is not a financial or legal advice. It's just a conversation about things we find interesting in Web3. Views expressed are our own personal opinions. Deco members or guests appearing on the show may have positions on assets they talk about.
All right. Today I have with me Andrew, who's a co-founder at HypurrFi, and Andy, who's head of growth at HypurrFi. Yeah, since you haven't been on too many podcasts as of now, and it is my privilege to host you guys at the beginning of your podcasting spree or podcasting or your roadshow, I would like to start with your backgrounds and want to understand a lot more about why did you guys choose to build HypurrFi?
Yeah, great. I'll start you with my background. I've been building in DeFi since pretty much the dawn of it. Most recently, prior to starting this company, I was building at Astaria, which is kind of like tooling around lending in for NFTs and then kind of generalized lending using intents. And so building like lending protocols has always been a fascination of mine. And then, really why we, came here. Actually, I'll answer that after Andy's given an intro. Just turn to, himself.
Yeah, I've been building in crypto for a while as well. I was an academic beforehand, and I left in it was 18, I believe. So I went through the 2017 party there. I didn't make any money or anything, but I got the taste, and I was a media researcher before. And so the idea of using a new technical system to do different things with social interactions and, different sort of capital allocation was really fascinating. So I ended up working for some startups. I ended up working for Ava Labs, Status, and eventually Chainlink for quite a while, where I did podcasting. That's why I have this excellent mic, and video and social, and a lot of content around their technical infrastructure and just how it all worked. Eventually, I met up with Andrew and his co-founder, in some group chats in crypto like you do. And they had a really fascinating idea for a particular system that uses revenue to, build sustainable economics. And that got fascinated. And that eventually led us to Hyperliquid and where we're building today, which is very exciting.
Yeah, and Andy is employee number one in our whole apparatus here. He's one of those people who insisted that they work with you, which is a great signal for those would-be founders out there. Find that person who refuses to take no for an answer. That's someone that you want around you. But why build HypurrFi? I think the better question is why build on Hyperliquid? And I think that's a great way to answer why we're building HypurrFi. And so Hyperliquid is a fascinating enigma of an ecosystem where the success it's born on the back of its constituents. Okay. And so the largest participating base across the ecosystem right now is airdrop recipients from the Hyperliquid TGE. The economics of the TGE and how it was delivered, we've written articles about this. It was absolutely perfect. Really rejuvenated my belief in new ecosystems, airdrops being an effective tool for distribution, because they had been, largely, farmed to zero across the board if you look at any major airdrop that's happened in the last 2 or 3 years. But Hyperliquid has also a user base that is aggressively tailored for finance. And if you look at building in the financial space on top of chains today, DeFi applications are very much the dominant form of most throughput, but they're not the most dominant persona that you see in your communities. So if you have a DeFi app on any of the major L2s or in Solana as an example, retail, like non-financially informed individuals, are a large chunk of who you interface with. Probably, 19 out of 20 people that you're talking to in your ecosystem are not financially informed or don't understand broader financial mechanisms. This is much different in the Hyperliquid ecosystem. I would say you're probably 17 to 18 out of 20 of your users come from some form of financial exposure. And those, 2 out of 20 that are necessarily not from a financial background are most likely, the successors of DeFi of the last 3 or 5 years. And so your user base is highly concentrated on making money or financial products, which means that you don't have any of this, captured conversation around DAOs or governance or, decentralized flows and requirements of things. You have people that are looking to take a step forward, like a completely different journey through crypto and through blockchain technology with hard finance at the center of it. And so what that means is that a lot of the stuff we've been building over the last few years in DeFi, and predominantly targeted chains that have a lower throughput or a slower block time, and also were designed with the lowest common denominator of user in mind. They weren't designed for somebody who sat further up on the financial acumen scale. They were designed for people who literally do not know how to do anything. They can click buttons on a phone. They don't understand how to do proper, DD or research or mechanism design or understanding. And that's fine. But this is an opportunity to actually play with like the Wall Street titans and those that sat on commodities and exchange desks. And their job has been trading for a predominantly large period of time of their life. And that's also who a large chunk of the builders here are as well. And so what it's made is the most like meritocratic PvP battleground for a founder that you could ever want to be in if you care about DeFi or finance. And so it's like, why build HypurrFi? It's like, I want to compete with people who care about the future of finance and where things are going. I don't want to necessarily worry about having to build for everybody right now. I think if we get stuck, like there are so many people that are building for everybody. I want to build for those that are financially like at the top of the table. Those that do consider themselves to be an elite trader or, like a whale because they've, correctly traded macro environments at scale. A great call out here is like, look at Shoku building unit protocol as an example. This man is someone who has traded, across all aspects of finance over the last like decade of his life, but then, chose to put it all down and come back and build, because he's overwhelmed or overtaken by the opportunity to build alongside of Jeff and company here. Like, I think that resonates really deeply for a lot of the teams that are currently building here, is that the opportunity to be just so close to the source of change here is like, it's intoxicating. And so why build HypurrFi? HypurrFi is a way to express our interest in building around traders, leverage lending facilities, and to allow for people to have access to what we call like clean leverage, essentially is, very transparent means in which way you can access, additional like utility for your trade, so to speak.
Crypto has had a challenge for a long time finding product market fit. And one of the clear products that fit is speculation. And this is this basic level of finance is I buy an asset low, hopefully it goes high, speculators. And that's a very simplistic but effective tool. But, when you're building a startup, if you're trying to address absolutely everyone, that's a great goal to have. But to get traction and to really move the needle early is you need to find a niche. And so that's what's really interesting about Hyperliquid is like, okay, those speculators are there, but there's this other level of people who understand funding a farming rate and like, just, where does interest come from? Where does yield come from in, macro and micro environments? And just that level of sophistication is enough to say like, oh, well, this is an extremely motivated and capable user base that we do want to build for. And that lets you build tools that have flywheel effects instead of forcing flywheel effects through just whatever token emissions or whatever your strategy happens to be. Is there are people there who are seeing that future and saying, okay, these tools that are available out in traditional finance on these various desks, these sophisticated tools, we can get to those on chain. And this is how we do it is, well, we've already got enough volume and enough movement, like from Hyperliquid, the perp stacks generates enough of that revenue flywheel for itself already that kicks into the rest of the community. That's a super compelling user group and a super compelling ecosystem to build in.
And just to add on to that, like, I would say a lot of our conversations with users that have come into this ecosystem as well, they were not around nor have participated in the broader aspects of DeFi here as well. I think that was actually an eye-opening moment for us when it came talking to our users in terms of what they want. The tools that you have today that exist from other ecosystems, like the, smart contract tooling or, just application tooling, infra tooling, whatever, it's great that we as builders understand those things and can bring them to bear relatively easy. But there is still a massive education component that comes with people who weren't a part of the previous, environments. And so using understood tools that already have a massive education component available with them that you can go point at or that are well understood definitely helps in terms of bringing this next set of users online. If we all came out here and we're building brand new 0 to 1 stuff today, and we had, beyond having to adopt whole new tooling infrastructure for it, contract bases for it, as well as, whole new educational components in terms of how to bring these users in, like the ecosystem would be nowhere near where it is today. It wouldn't be able to move as fast as it possibly can. So that's like the beauty of having all the open source technology and everything behind you is that you can just point at it and bring it forward to new users.
This like following up on what you said, Andrew and Andy, I think it is very interesting. Like within DeFi and within crypto as like broader landscape, you see two kinds of builders. One who want to target almost everybody. And in the name of, like I want to bring like 1 billion users on chain and whatnot, right? But it does matter what your application wants to do. like if your application is something niche, you can't really target like almost everybody who has internet. Like that is just not realistic, right? And in the process of making your app trying to cater to those users, you simplify a lot of things where you lose that nuance. And on the other side, like there are builders like yourself who are saying that, okay, I don't want to target everyone. I don't want to build an ecosystem from scratch. Here is a already curated set of users that is ready for me. I understand that they are pretty much aligned on the use case that I want to build for. And it is okay if I don't capture like all of the value myself, right? And I say all of the value because you are not building a chain, you are building an application. And some of the value that you guys bring in tends to go towards the infrastructure that you are using. But what I hear you saying is the cost of building that infrastructure and building that community ground up is way higher than, if you had to just use it and share certain part of your revenue with Hyperliquid.
Well, we don't want to target everybody yet, but look at the history of people who are saying, oh, we're going to hit everybody on chain immediately. And what do? You have to do these mass marketing campaigns that cost millions, which means you're raising millions very early before you have product. You're paying for rented TVL to show traction, to get people to believe that you have traction. And it builds up this, a machine that is not sustainable, and has time and time again led to these airdrops that just go to zero, and chains that are ghost chains and just empty. And we've seen this so many times. Like, you've been in crypto, you don't even have to be here that long. You've seen like plenty of examples of that. So why do that playbook again? Instead, like, look to some startups, so some startup history in the past 50 years that shows, get traction, get revenue, get real users first, and then build on that. Build what users want, build what they're asking for, and then you can expand into different product segments. So that's what I see. When I look at Hyperliquid, it's just like, well, okay, what do these users want? We know they're real. We know they have money. We know they want to spend it. They're used to spending fees on trading. And so that's a really interesting user group that we can start to talk to first to build revenue with products that they want. And then, okay, that lets us expand. What do they want next? And that's the roadmap that we've taken, the perspective we've taken as well.
Do you think that the Pareto principle applies here as well? What you are targeting really is the capital and not the users. And it is very likely that 20% of the users have 80% of the capital that you want to target.
Yeah, so like we have a really interesting thesis here. I think it's different than a lot of people is, like we're building products for tax advantage generational wealth. Okay, so if you look at some of the stats around the airdrop, I think about at this point in time, like 40% of participants have like sold or moved capital. So about 60%, still holding or in some capacity still trackable around the original holder, which means that you're sitting on, from an FDV perspective, about $8 billion or so dollars of tax advantage wealth over time. And then, if you are a believer that Hype as an ecosystem is going to continue to black hole and attract capital, like your TAM continues to grow exponentially with the value of Hype. And so, like, building for everybody here at this point in time doesn't make sense. Not everybody is generational wealthy in terms of the broader Hyperliquid ecosystem. There's only a small sect of users that, like they're really the top, 1 to 5% that have most of the value here. But what you do by building for them is you figure out all the pain points and the hard roads with a highly capitalized base who will pay more in fees and premiums to get stuff done because they can. And this allows you to then commoditize all that infrastructure and access to everyone else behind you. But it makes no sense to figure out how you're going to solve for 1 billion people right now. There aren't 1 billion people using crypto. Like, it's just setting yourself up for a failure point, day zero. Now, it's different if you're building for a chain and you want to onboard and scale all these users to your product. Look at Ethereum or Solana. Like, these are goals that these chains can take on. They've hit escape velocity. But for a product building, you have to really figure out what your distribution is going to be. And if you can't build distribution, you can't sell anything. And sometimes you build distribution by building a new product. And sometimes you build distribution by forking something to solve a pain point. And so for us, we are building for users who want to express their long-term interest in holding Hype, being exposed on it from a tax advantage perspective. And they want financial services that allow them to participate in that value. So capital efficiency is a trader's best friend. And so building tools and services that actually allow users to actualize their wealth in real time instead of having to sell. That's the only way that typically, you can actually actualize your value.
And we've already seen flywheel effect from this, right? We've got this set of highly motivated, capable users who are using the tools. And then we start building things right on Hyperliquid itself, perps and the HLP and all these things. And then we start building lending tools and leverage tools, a variety of builders on HyperEVM. And many of those funds come over and those users come over. And because of that movement, because of how the ecosystem is actually generating flywheel effects itself, we have inbound from hedge funds, from other liquid funds, from high net worth, high frequency traders, from retail, like all these speculators as well, is they're noticing not just the TVL value, not just the high, top numbers, but the movement and the ecosystem and the fees and that sort of things that you can generate revenue because people are using the actual products. And so the inbound is also other people who are, maybe they didn't get the hype airdrop, maybe haven't been trading, they're not market makers who are trading from day one on Hyperliquid, but they're shops and funds that are seeing this activity and saying, well, okay, I need to get exposure to that as well, because that's where the action is, right? You got to go where the volatility is, that you got to find that risk. And that's already what's happening. And Hyperliquid, right? The perps engine generates fees. It just is a machine and it generates that revenue and that passes back through the ecosystem. And that's undeniable that perps is like this great product that crypto has found as an industry. It has demand, has a fit, and Hyperliquid team built an awesome product in the DEX itself and the core experience. And so it generates, it's the beginning of this thing, which is just a very different perspective of going for, well, we're going to generate flywheel effects by, dropping tokens first. No, they dropped a product first and that product worked and it generated fees and then they kept spinning that flywheel. And so why wouldn't you jump into this ecosystem and take part if you've got something of value to bring as a builder? If you've got value that needs to find yield, you got to bring your value over. So that's our perspective, is it's already working. We build tools to let people do more, and that is attracting more and more. And we see that every day, more announcements every day about who's coming to the chain.
Typically, when we talk to builders who are in early stages and, we try to tell them Hyperliquid as example, a lot of times that comes across as an unrealistic example because people who were building it without raising money already had made money, right? So they kind of got over that cold start problem. To build a product, you need the capital. You need the capital to have So what is your response to that?
Well, we have investors. We're not opposed to raising capital. If I was Jeff, if I was a Jeff, I would have millions of dollars and would need to raise capital. Jeff is a genius, right? And you don't just make that much money accidentally, right? It's not right. So I'm not Jeff though, right? And so I'm very proud of my abilities, but I also realize that capital is an even more powerful tool to have in your arsenal. And so whether you raise capital from community, I think ICOs actually were the most amazing thing ever. 2017 callbacks, that is the democratizing access to capital for everybody. And so, but there's a lot of drawbacks to raising and how you raise, right? It's really the people that you decide to bring into your orbit as a part of your journey, either make it the best time or the worst time. And that's just not necessarily for investors. That's for employees. That's for anyone on the advisor. That's people in your community. All of that matters. And so that's all in my mind, all an investment. Hyperliquid is a massive success. They don't pay for marketing because we're all zealotry and we love it so much that we market it. But if we didn't love it to the point that we were screaming Hyperliquid on every third tweet on Twitter, there would be a marketing problem and we would have to figure out how to address that as a community, but your economics and your intents can have profound impacts on how people view you. And Jeff and team have shown themselves to be nothing but, fantastic.
Well, and to be clear, there's plenty of teams that have built stuff without funding and failed, right? That's not the secret ingredient. You can't just go and do that. And it wasn't a cold start problem where they had their own money, they built a product, and then they had wild success. No. They started very early and had very few users, low liquidity, and they built over years to what it is today, right? And go back and look, Hyperliquid's been going on for 2 years, I think.
2.5 now.
2.5 years. So it's not an overnight success. It is definitely still one of those stories where they built product and they worked, and that's not a guarantee of success. And so taking funds is not necessarily the mark of a bad project or a good project necessarily. It is, like Andrew said, who do you bring into your orbit? How do they support you? How do you build the product for the users and that sort of thing? And then there's also luck, right? Y'all have been around startups long enough. There's an element of luck to this. There's fortune. You build a great startup, it starts to get traction, and then COVID hits and it's over, right? That happened to you, Andrew, right? That's a real part of this. And so sometimes the stars align and we happen to see, oh, the stars are aligning here on Hyperliquid. This team has done this very well. We need to act and test this immediately. Is this a place where we need to go? The answer was a clear, resounding yes. And so it was all forces go, like engines move so that we can be a part of this and build for those users.
One final comment on there on things like there's like a really good polar extreme example, right? Hyperliquid is on this side of things, no VC funds, massive amounts set aside for community and incentives and, contributions, purely deflationary model, all great. Another token model, completely different. Friendtech, as an example, raised a bunch of money, gave 100% of the weight of all the exposure to the community. This thing is like, does not exist. Yeah. Okay. And so like there is some degree in the middle of where the successful bounds are. And so, yeah, I'm just, I think it's a fascinating time to be building.
Okay, switching gears a bit, in your experience of building on Hyperliquid, right? What are like some of the quirks that you find, okay, I mean, these are the things I wish I had known earlier. That is one. And second part of the discussion would be around, talking to builders who are exploring multiple avenues or multiple platforms where they want to build applications. They're either on the fence of, deciding, okay, I want to build on Hyperliquid, or, they have considering other ecosystems in, against Hyperliquid and not in favor of it. What do you say to them?
Let me say why you should build here. The tooling it's EVM compatible. There's a lot of nuances, a lot of pain points. And so you should want to build here because if you can succeed here, it's a mark that you are the top of any like category of builder on any chain anywhere. And I say that because there's no help here. There's zero. 100% zero help. And I don't mean that in like no one will help you. I mean like there's no foundation that sits there and provides, quality infrastructure for you to build on top of. The docs aren't always accurate or updated. There's no DevRel person that can sit there and walk you through how things work. They just don't exist. The community is what you need to tap into. And so when you come though, you need to like contribute to that community and you need to provide services and means as well, because if you don't, like there's nobody that's going to do it. So if you have a unique thing or you have a network that can help, this is kind of becoming memey, but I often say like, ask not what Hyperliquid can do for you. What can you do for Hyperliquid? Because that's a better framing of why you'd want to be here, because you become the person who contributes. Suddenly the value that you provide becomes relied on by others. You gain value just by the fact that you've given value. And it's a very unique ecosystem where like most places, have a predefined, fast bridge, or they have a predefined DEX, or they have a predefined, like product that's used from the foundation or pushed forward, or you have an account abstraction wallet, like, whatever it may be. Some L2 almost always had its own unique offering. And so you can't compete on those fronts. They're not available to you, the general public. They're already captured points. Most likely the foundation is giving grants out. So you have these teams who've gotten runways to go much faster than you can. None of that exists here. It just doesn't exist. And so you have equal footing with everybody else. The only disadvantage you have was how long it takes you to start. And so you should start yesterday so that you can be on equal footing as fast as possible. And there's another meme that's very true. That is, everyone is coming. Our DMs are flooded with DeFi teams, projects from every other chain you can possibly imagine that is trying to trip over themselves and run faster than every other team in their environment to get here, to get in front of the users, because these users are actually engaging. They're actually telling you what they don't like and do like. They put their money literally where their mouth is. And really like if you talk to like those that are selling picks and shovels, any of the service providers that provide Oracle services or data or anything that you would imagine on any of these chains, go ask them how much business they do that is not Hyperliquid. And you'll be shocked. You'll be shocked to find out how little that they do is not Hyperliquid.
So, and that includes, by the way, teams and infrastructure that are non-EVM. So people from all over crypto are noticing and trying to figure out how to come and trying to work, how do we get there? If the foundation's not giving a grant, or like, I don't have anybody to talk to, how do I list? Like, how do you do token listing on Hyperliquid? Like, these are questions that are not always known, right? That it's not like there's a clear playbook. And so it is hard. It is hard to come here. The other warning that I have about, other than the technical side and like sort of sorting through the community morass of like who's actually on Hyperliquid, who will help you, it's very clear when a project comes to tap into liquidity and that's it. And it's hard to split your attention as a project. You're on 10 different chains and you've got to decide, how are you going to split your attention among those chains? How are you going to drive liquidity there through marketing, through relationships with your holders, all the sorts of things that you do on the growth and biz dev side. And so we do see a fair amount of products that come and they add HypurrEVM as one of the drop downs, and then there's not that much traction. Well, that's because of these users, they're active and they care. They really do care. And so they pay attention. And if you're not adding value and they see that, then they're not going to reciprocate. And so there is a challenge, and you've got to decide as a team. Now, we've spoken to some teams across DeFi who have recognized this and said like, okay, we're coming, but we got to figure out how to do this right. And so, we see everybody's coming, but it's taking a while. People are figuring out, how do we do this? How do we allocate this? Because they've got other deals with other foundations that are due in, 3 to 6, various quarters and things like that they've had to hit because of their past relationships. But we're seeing that them come over and figure out, okay, how do we actually make the best of this and provide that value? And those are going to be like the things to really think about. If you have a protocol and it's suffering on whatever chain, whatever ghost chain you're on, and you want to come over, okay, but just because you launch, it doesn't mean it's magic TVL time, you're off to the races. No, you're going to have to do some real legwork and figure out who you're working with, how you're going to build that trust among people, provide real value in your product that's not just faked and made up, like how are you going to actually generate those APYs? What tech are you going to use and all that? So it is a challenge. But like Andrew said, that challenge is really exciting. Like, okay, how do we figure this out? How do we put that business together? How do we put together products that people really, really want? And I'm seeing some stuff that like is in beta mode and demo mode that is sick. It is so cool what people are doing. And it mimics like that sort of on-chain, or rather that traditional finance sort of scope of products that are available. Those are starting to come online. You see a bunch of these products that smaller traction now, but as people understand what they are and how they work, they can fit them into a broader portfolio that's more than just speculation. It's really cool.
All right, awesome. Thanks for that insight. And before diving into HypurrFi, I want to ask both of you, what are the best crypto products that you are use? Obviously, you can't say HypurrFi.
Andrew's got a bunch, right?
Yeah.
No, I was saying that think of a friend who doesn't use crypto product and you probably have to convince them.
Yeah. So, I mean, if I had to convince someone to come use a crypto product, probably Polymarket. That'd probably be the easiest one I think someone could reason about as to why they would want to go and click buttons there. And it's just gambling, but it's gambling around with context that they can understand.
Oh, me? Boy, I've been trying to think of something that's not related to HypurrFi, and I'm having a tough time. Well, I look at DEXs, and DEXs aren't for most people. Providing liquidity, that's what I like to do. I provide liquidity. I understand it. I know the risk around it, and so that's my use case. I'll call out one on Hyperliquid is the HLP, the Hyperliquidity Vault, right? Like you can take USDC and you can stick it in there, and it provides liquidity for the perps and the market making functions on the chain, and it generates a pretty good return. It's variable. It's risk. It's not like just a passive yield thing. It's an actively managed vault. And so there is a risk there, but it's good returns. But what that does, right, is you have to kind of understand how to get there and how to work with the chains and do those sorts of things. Another one I really like I'm a fan of a bunch of wallets, but I really like Phantom Wallet. I think it's good. It's well designed. And some of those mobile wallet experiences help abstract away error codes and things like that you need once you kind of get into the mess. But it's a nice onboarding, like first journey in is Phantom. Rainbow also does a great job of that. And there's some other new mobile apps that use builder codes to provide the Hyperliquid perps markets as well, that also do a good job of that. So you can start to get your head around perps and trading and stuff like that.
I think until a week ago, Phantom made over 1.5 million through fees using builder codes. So, I mean, if you have distribution and you need liquidity, use builder codes, and that's just insane. I mean, for them, it was probably a few lines of code and making adjustments to UI, but the impact that it has had was just insane.
Everyone is coming.
Yep.
I think Phantom's a fantastic, you can do a whole case study on why Phantom's going to win. But I think that builder codes is just the tip of the iceberg. I think Phantom goes into their own HIP3 markets. They have distribution. They'll capture way more fees. They can find someone to underwrite the risk on, the markets and oracles. So that's like a whole other thing. The Paradigm in their back pocket as an investor. So Paradigm could underwrite the Hyper acquired the stake into the markets. And so they could easily buy tickers, underwrite them at scale. And so I think that there's just distribution is never been more powerful. Hyperliquid is you just really crack the distribution pipeline. Anyone that's got a wallet that's got distribution, any user platform, everybody's becoming a Hyperliquid reseller. That's what HIP3 does.
I thought of another one is vaults. So earn vault on DeFi protocols, right? Farming your own DeFi strategy is hard and it's complex. You've got to track a lot. And so with the emergence of vaults a couple of years ago, you saw all the DeFi educators from 2020 and 2021 just evaporate. And there's very few that are public because they had all the alpha. And so they went and just started their own, funds basically and curated these vaults. But that's a really compelling product where somebody who can manage that and run that and provide information about it can just open up deposits, and anybody can deposit and get 10, 15, 20% on a stable coin Stablecoin or whatever asset it is. I think those are awesome products. And I think we're about to see a lot more of them on Hyperliquid. It's one of the areas in Hyper EVM that hasn't quite reached escape velocity. Morpho's there, but there's quite a number of other providers that are on their way. That'll be.
Who's building it currently? Or is there a product like that right now?
Morpho has vaults on there right now, which Hyperbeat has, and I think Felix also uses Morpho. There's a number of sort of independently shopped vaults as well, but then others are coming.
All right, HypurrFi, right? Why lending? I know you answered it partially when you said that tax advantage and stuff, but I want you to double click a little more. Why leverage lending and why does it matter?
Yeah, I think it really ties into our mission around debt servicing at scale. So our North Star here at HypurrFi is to have more debt under our purview writ large than any other institution in any other point in time in history. So very lofty goals. We think very big in terms of our wants for exposure on debt and debt servicing. Debt is at the core of everything that we design. And so if you think about lending as a principal, component of how debt functions and works, and keeping with our notion that we are targeting predominantly traders from our overall user persona, leveraged lending allows them to express directional needs in bets as well as providing a means for capital efficiency on their assets. So, we have a lot of users that want to short everything else in the ecosystem on a spot perspective, and they only want hype. So they deposit hype and they go net short pretty much every other blue chip asset. And so for them, it's part and parcel trading in some capacities. But for other users, they just want it as a way to express directional intent on a non-levered capacity, and they just want to be able to spend capital and borrow against those in real time. But what's most important as a result, though, is that lending is a piece of pretty much everyone's financial discovery or journey in some capacity. And it really gives us an easy principle an easy primitive to have everyone come to and talk about and express their likes or dislikes about. And that is how you do, I think, really good customer discovery around what's coming next. Most of the stuff that is to be built, it's actually going to scale to billions and billions and billions. I don't think it exists today on chain, ourselves included. It's the next 0 to 1 that is completely designed to maximize and capture all the capabilities of the Hyperliquid ecosystem at scale. So that isn't an Aave fork. It's not a Frax fork or, a synthetic dollar that exists today. There is a trajectory that's coming, though, I believe, that the conversation is best understood through the lens of those that are participating in the ecosystem. So we want to have a tool that allows us to have really good conversations around the financial needs of a user base that is highly exposed to the direction of hype and, are the prime constituents. So that's why lending right now. But I also like to say that lending is a product, is a tool in our tool belt. It is not necessarily the thing we have. So debt is what we care about. Lending is a means by which to express debt in the current form. That can take on a number of different forms and fashions, may not just be pooled or isolated, could be highly bespoke financial contracts that look and feel more like a prime broker, or it could be mortgages, facilities, whatever, make commercial debt down the line more like a neobank. So we think about these in terms of just broad directional places we want to go. And in a decade, we may look like one of those two, a neobank or a prime broker, but we're actually not building either. We just find ourselves building technology that facilitates debt at scale and allows for traders to express intents.
And the leverage bit.
Yeah, so the leverage part of it is for the traders, right? So if you're able to lever a staking trade, be able to lever up into Athena or the HLP as an example, strategies are a big part of this equation as well. We don't have them in the current form, but they're a big part of our long tail destination, is giving users the way to, they want to go 2-3x lever, they want to do a straddle or some kind of structured position that allows them to express directional needs of a market. And they want to lever on that, borrow capital against a strategy. We think all of these things become more and more relevant to our user base. And so allowing them to take leverage as a part of the actual lending protocol, we think is what really drives it in for the user base at present. Because at the end of the day, they're all traders. They all want to maximize the efficiency on their actual directional bets.
And so when you mentioned straddles, that reminded me of Ribbon Finance. I think it had vaults, as Andy mentioned, as an interesting product, right? Where there were covered call vaults and stuff like that, which is to give you decent APYs. But I think because the options markets were not so developed, and to my recollection, this was built on ETH L1, and which was very difficult to use in terms of gas efficiency and whatnot. So I don't think, for those reasons, I think it did not reach escape velocity. But would something like that be a part of your roadmap down the line? Have these vaults that use debt in various creative ways, and so that users can chill a bit and, not obsess over routing their capital from different venues 10 different times.
Yeah, I think there's a ton of stuff that you can look at how a user that takes a positional bet. And so one of the interesting things is like you can get a loan from HypurrFi and you can bridge it into Hypercore in a second, and then you can go 40x long in Bitcoin a second and a half later. Like, where else does that exist as an actual feature? You also have the precompile writer, core writer functionality that allows a smart contract to bridge the capital in and open a perps position. So now you can have a delta neutral smart contract. Maybe that smart contract is also an AMM. Maybe it's taking a directional position in one way and instantly hedging it and doing an Athena style trade on the other side of the equation. Maybe you have this whole positional composition of multiple of these markets in your portfolio, but what you realize is that you're not actually exposed to volatility. So you do an inverted straddle, and so then you get complete exposure. And so maybe you're paying for, maybe you only need complete exposure during FOMC. Maybe you want to pay a premium only for, essential proper coverage for large scale macro movements, but you're actually directionally feel comfortable, but you feel really uncomfortable for a small period of time. We want to allow these traders to express these interests and these needs and put that out into the open world so that the broader debt marketplace can facilitate those needs. So you might be familiar with like cow swaps.
Those trades are starting. Those trades are starting now. So D2 is a great partner. They use HypurrFi markets to lend and borrow Bitcoin while they have a position going on Hyperliquid Core, and they're farming that rate and bringing that out. And so those types of strategies are already emerging. First, with assets that have a ton of liquidity and like known sort of risk parameters on Bitcoin, but we see a ton of other companies and projects gearing up and figuring out what do those vaults look like? How do we, manage this basket of stablecoins and write and do stablecoin ARB as a product, right? There's a ton of stuff that you can stick into vaults. The question has been, what do the users actually want, right? I don't want to offer users 6% on something right now because it's bull market. Nobody cares about 6%. And so you've got to think about those structures and see what is being built and what's being asked for and demanded. But those tools on Hyperliquid, the HLP and long and shorting positions and all that sort of stuff that you can do there, they provide for this. And so we see a ton of activity of curators building these strategies. For us, the question is like, all right, well, when are we going to enable that so people can do it on HypurrFi and auto loop and do all the fun little toys that we have enabled? And we already have great demand for that. Like just for example, like we have debt swaps. So if people take out a stablecoin loan in USDE, let's say right now, and the rate goes up to 30%, that's not very sustainable for your strategy. You can just debt swap into USDT. Maybe the rate's a lot lower and you can just do that at size. So when we think about what we're building, we see demand specifically for that as an example with one of these curators. Okay, well, now we got to make sure we have that debt swap liquidity. And so how do we provide tooling within our app that makes that liquidity very low slippage and very low fee so that they can do these strategies? So that's how we think about like lending, right? Why leverage lending? That's the base of everything. You have a position, you can take a loan. That's the fundamental like foundation of what it is. But as people build on top of those, they'll need these other different specific niche tools that are not necessarily like these big splashy other products. But in this case, like, how do we make sure there's a good liquidity and good route to service this debt swap that lets their strategy be more effective?
Love it. There are a couple more things that I found interesting and want to understand your rationale right behind having those things. One is obviously the synthetic stablecoin. How does that help you scale all of this? And how do you think of composability of the stablecoin? Because if it is not being used elsewhere, then it's a problem, right? I think we have had issues with DAI scaling, MakerDAO's DAI. I mean, I think it scaled significantly in the initial period. And once USDT and USDC were there, you just see, that growth kind of get capped or that. So yeah, why stablecoin?
Well, so USDXL is a synthetic dollar, and we're very careful about how we talk about it just in relation to specific legislation that's gone through in the United States. So to clarify, it is
not a stablecoin. All right.
Correct. It's a CDP. And in the past, as you look at DAI and USDC and USDT, is they all fulfilled a really similar function, especially USDT and USDC. They are a dollar canonically, and they're supposed to have huge market cap, and they're supposed to just have a ton of liquidity, and that's what they do. And they're great at that. Honestly, they've done awesome at that. DAI takes a sort of a different role where you can take a position against ETH in particular. And so you start to see with the emergence of DAI, okay, stablecoins actually have different use cases. Over the past 2 years, with the emergence of this huge stablecoin boom, Athena in particular, but many others, stablecoins do have sort of different niches. And so these different sort of pegged assets can serve different functions. When we think about USDXL as a synthetic dollar, like what can it do? I don't really want to compete with Circle. I don't want to compete with Tether. I don't think that's a good business model. They've done very well, and I'm not out to displace them. So rather, when we're thinking about USDXL, it's like, what need can this serve for users that is not currently served by other markets, that needs to be served by our product? So that's our general philosophy. It's like not to go out and displace Tether. They're an awesome partner. We love Tether and the USDT Zero crew, like really fun to work with. Our card runs with USDT as well. And so how do we position USDXL to make the most value for the users that want leverage, that want vaults, that want to service this debt?
And so, yeah, to follow on there, like the biggest value that you get from USDXL and its design. So right now it is a CDP model. So it's a fork of Go. So it's you're borrowing right from the pool, but it's a crawl phase. Okay. We look at this as being more as a means of a debt rail, a servicing rail for new emergent markets. So it's designed at its next phase of iteration design is a true to form hybrid. So it's backed on treasuries, which are, essentially a stable coin, right? Revenue generating stablecoin. But that's not what's actually exposed to the user. The user just gets a synthetic dollar as a result of it. And so what this gives you, though, is that as treasuries start to grow into the reserve, you get a redemption floor. So like I've been very vocal about this, like CDP coins do not scale. Okay. Like USDXL would never go to be $1 billion, $100 million coin probably without a ton of incentives pushing people to want to go do that. The other side of the coin, though, is that there are emergent markets, and you're going to see them with a lot of coins and a lot of different assets that can't afford the premium that it costs to go into to Hypercore. They're going to need liquidity, and they're going to want liquidity at scale for these new emergent markets. Traders will do what they always do best, and they will step in and figure out what that is. USDXL is a prime facilitator here in this design where it will have essentially, over time, as like a 70-30 backing, 70% from US treasuries or other yield bearing assets that are relatively stable. So you could imagine some composition maybe in the future of, profits go into the HLP or whatever it may be. And then you're going to have 30%, give or take, that can be minted on demand from the pooled market, from people who want to do the CDP model, which means that you can actually have capital flowing that's leverage to go provide liquidity into these new emergent markets that need it, that are going to pay a high premium on that. And that's where I think that like DAI succeeded in the early days is we all wanted leverage against our Ethereum. We had no capacity to get it. So we created a debt note, which is what these assets are really. And then you want to start backing your debt note with beyond just debt over time, because there's no incentive to pay your debt, right? When you have a CDP, you are short the synthetic dollar itself. You are not expecting, or rather your directional bet as a trader is you hope it goes to zero, because that means that you get a free call option on your loan. But now the economics, like the rational economics kick in, and there's no way that a debt note's going to go to $1 because there are incentivized borrowers. At some point in time, these are percentage point gains that make sense for you to repay your debt, which is the mechanism at play. The hybrid model, though, is how you actually scale this to make sense, so that you get stability on the peg through redemptions. You allow for redemptions at scale because you drive into new emergent markets that provide a decent enough APY or demand for the dollar, the synthetic dollar, that people will come and provide stables or some other assets by which to mint it or borrow it on demand to actually provide it into these markets. And, we've seen like leverage for Hype users as an example, or L-Hype users, they're predominantly paying 20, 30, 40% APY for leverage because there just is no other vector or opportunity for leverage for them right now. And so it's not about necessarily it becoming something that scales to billions of people or hundreds of millions of dollars, but it is a vector or a tool to fill in the holes for where leverage needs to find a way. Like leverage will always find a way. So you may as well find a vector to capitalize that and provide it as a tool for users.
There's a ton of value as a technology to have it embedded in a system that can flash mint, that can flash loan, so you can do some of these really DeFi fundamental actions within smart contracts for vaults and for whoever else needs them. So as a tool in the toolkit of a lending protocol, especially those that want to serve lending across isolated markets or vaults or wherever it is in a variety of locations, it becomes a really powerful wrench to have to give to these builders.
How do you think of composability in this case? Because I think Felix has its own CDP. I'm not sure about Hyperlend, but if there are multiple applications that have these CDPs, then do you think that it takes away from the user experience a little bit because every time there's a different CDP that you're dealing with as a user?
No, that's just atypical crypto. There are going to be 1,000 stablecoins. There are going to be, another 1,000 synthetic dollars. Like everyone wants a stablecoin.
M0 is the backing collateral for USDXL. They're coming to Hyperliquid, and they're not coming just for us. Halo is already on there, and their backing is on Ethereum right now, but that's coming to Hyperliquid, and many more M0 coins are also coming, and they are by far not going to be the only stablecoin, related project that comes to Hyperliquid.
M0 is?
Yeah, M0's.
Yeah, they announced a little while ago. Everyone.
Yeah, you have like, the Theo has their T-bill now. That's a product, won't be long before that gets wrapped as collateral for stables. And it's just all the things down the line, it becomes pretty clear.
All right. So we understood like where synthetic dollar comes into the picture and, how it helps. What about the card? Like, are you, so you have all these collateralized positions with HypurrFi and you want to spend against them, right? So you can probably that's where the card comes in.
Exactly.
But like, how do you deal with integrations with merchants and with payment networks like Visas of the world? And okay, how does all of that work?
Yeah, we have partners that sit in the middle and help facilitate all this stuff with true to form. We are not a card issuing provider. That is not a product that we build, but it's a service that our users demanded. Since pretty much the first week of going live, it was like, when can I have a card that I can connect to my HypurrFi? So we've been, myself, I've used pretty much every one of these products that has existed in the last, like, I would say decade. I've jumped through every possible hoop that you could imagine to be able to spend DAI back in the day. I will tell you though that like, there's a really cool meeting point that happens as a result of the card. And everyone can understand this model that is a modern day human. They've used an EMV, or they have an Apple Pay or Google Pay wallet that they tap when they go to check out for places. The fact that this is integrated to your essentially cross-margined long position, if you want to think about that's what our pooled market is, you can tap into your capital literally in real time. There is no top-up mechanism, right? You're not like, you have no action to do. It's all borrowed in real time as debt. And then there's a new feature coming that you can be supplying. So what this allows, though, is that the pooled market rates are going to be driven by the speculators in terms of what they value leverage at. You as a non-trader can supply capital to facilitate their needs. You're going to capture the speculative rate, and then you get modern convenience by being able to go buy your groceries, or rent a car, or your next flight, or your hotel booking, and you never have to sell. Like, you sell when you want to, not because your life demands that you do. And so this changes your whole perception of what you would care about in terms of how you want to spend money. When I offer capital, it's always a pain point. Like, oh, well, like, do I really need to go buy that thing? You're like, well, I got to take out money to go do it. And it's a pain point to have to go do that. And, you wait 3 to 5 days for your bank transfer, your wire. But like, it's on my phone. I just go tap it on merchants and I can spend my money with no issues, no hiccups. And it is the most fascinating, like, rewarding experience when you just do it. And you get an Apple Wallet notification, and then your Xerion or whatever your portfolio manager pops behind you and shows you the transaction that just transpired. And you're like, shit, I just borrowed, 100 USDT Zero in real time. I took all my Waymos around San Francisco when I was there earlier this week. We're all through this product, and it was amazing. You just like hop, you call the driverless car with your internet money. Like, it's fascinating.
So Andrew has been like a longtime card user. He's been advocate for this. I've never done one. I've always been like a fudder on these things. But finally, we do a card. And so I finally try it out. And first, why the card is your first question? Debt servicing. Cards is debt. You do spend, it leads to debt. We want to service all debt. Easy. It's a no-brainer. It's a piece in that debt puzzle, and users have been asking for it. I was not one of those users, but hey, all right, it's my project. I'm going to try it out. It's mind-blowing, the difference. And as someone who's been in crypto and DeFi for a long time, I don't have to sell. I literally, like, the onboarding is super fast. The card is there. It attaches you to your position. You set a limit. You tap your phone and you buy coffee. At least a car. I paid for half of the down payment of a lease on a car, and it just goes. And it just takes the debt right out. And then we leveled it up because we've got this debt swap thing. And so I'm looking at my position, because it takes the debt out in USDT Zero, and the rates were high. It was close to 30%, but USDT was 9%. So I just did a debt swap, and I refinanced my credit card debt in 10 seconds. Like, it was crazy. It took longer to generate the transaction because the RPC was chugging than it to actually, do it, because I had the debt, I had the collateral for it. It all is done atomically. It was a total game changer, and has really shifted actually the way I think about, like, oh, we can use this stuff in the real world. Like, I always thought, like, okay, we've got this little finance thing over here, and eventually, we'll figure out how to get it. No, it's today. It happens now. You can just go online on Amazon or whatever and just buy whatever you want. Like, it's kind of crazy.
And it works everywhere right now?
Yeah, it runs on the Visa credit card network. So it's 150 million merchants plus worldwide. And it also works for booking cars, planes, hotels, anything that requires like a hold on your card or something can facilitate.
Amazing. And I'm assuming that multiple addresses can be mapped onto one card.
So how it is right now, actually, it's a one-to-one mapping, but we're advancing it as we go, looking at how we bring more of it online. But it's a delegation based. So you could think about, like, you could have a hard wallet that provides a limited delegation. So you only approve a debt buffer that can be borrowed against the pool. So if you want to give the card a 1K limit, you can only spend up to $1,000, and then you have to reapprove again. whatever you want to do, declining balance system. But it works amazing.
And I do want to say this is Swipe.fun is the partner that we work with. It's Brahma Finance, and they're fantastic. They're a really sharp team, and they manage all of that stuff. And so we work with them to make sure that we, help get the card to our users because they want to use it and do their debt position, but they manage the card and the compliance and all that sort of stuff. But you can check it out. I would be remiss if I didn't name drop this great partner at Swipe.fun. And what we're doing some more tutorials on that in the coming days and weeks. And so people will be able to see how to onboard. But all you need a HypurrFi position and you apply for a card. Come ask in our Telegram channels if you want to whitelist and get started going. It's really fun. And it's a brand new product. And so we're just starting to see the traction and figure out what do people actually want to buy with it. And but yeah, it's fun.
All right. So let me do this. Okay. If I understand it in very simple terms, right, what HypurrFi does, right? So there is leverage lending or lending, which is like the core part. That is where debt is originating, right? And then there are two levels, which are the stablecoin and the card, which are kind of giving velocity to that debt, right? Because if debt is just sitting there, you're probably not, squeezing as much as you can out of it. You need to give it some sort of a velocity, and stablecoin and the card are ways to, kind of give that debt some velocity.
Yeah, if money is not moving, it's not useful, right? Like money is really only valuable when it has velocity. A part of it, though, actually is like I'm actually a prime user of my own product, right? I'm building for myself in a lot of respects. So solving my own pain points that I've experienced over the last 5 years, last 10 years or so. But one of them is feeling comfortable spending your wealth. And you're like, you have a few $1,000s, in crypto, you hit it on a meme coin. Like I've talked to so many people who have round tripped capital because they don't know how to sell. They panic, they feel bad, right? Because they get conviction. Conviction is like it's a powerful drug, and it's really hard to shake when you have like a really concrete, like if someone told me that you need to sell all your hype for this going to zero and give me like a really concrete thesis as to why, and like you're the smartest person I have ever met, like, no, I'm not going to listen to you. I'm beyond convicted. It's just irrelevant. And then sure enough, it could round trip to zero. And I'm like, fuck, I should have listened to that guy. But the powerful notion is when you can realize, like, before I get there, I know so many traders who will go long and they won't close their positions out. They'll get liquidated because liquidated is what they've bought into on the trade. Okay. So like they aren't willing to, because they're deeply convicted on it. And if I'm wrong, I get liquidated and I lose money. I have a preconceived notion of what this outcome is. I think we can change that by enabling debt servicing. You don't have to sell. You're still exposed, but buy, spend. There is a real change in behavior that can happen if you give somebody the ability to spend money without having to necessarily close or change conviction. And that's what I think a big part of myself I've learned on my journey is like, when I was able to mint DAI against my Ethereum that I had amassed over the years of doing contract work and stuff, that was an aha moment for me. It was like capital efficiencies, unlocking power, not having to close exposure, just spend money. And that changes your entire behavior around how you want to express things. Like you should take all revenue, you should buy assets, you should then pay debts, and then you should lever up and then facilitate. Borrow against everything for your life has been very powerful for a lot of people, and it typically requires a lot of capital. Our user base has that. So at the end of the day, we just want to facilitate anything in any way that they can spend and borrow against that capital to enjoy life.
I heard you trying to fit HypurrFi into a box, and it's hard because it looks like a lending protocol. And then we say it's debt servicing, and you say, what is that? And we say, well, it can be it can be all these things. But that is the goal, is Aave has done an amazing job. Euler has done incredible, right? USDC and DAI and like all these DeFi titans and various stablecoin and finance titans have done an awesome job building these core products with product market fit. But there are gaps, and they're not always suited to fill those gaps. So you look at upstarts like Wildcat Protocol, under collateralized lending. Like, how do we do that on chain? Well, okay, upstarts can solve those problems. So that's just an example. So when we look at debt servicing more broadly, there are gaps and there are these missing pieces. So where can we fit in and fill those? On pooled lending and like the basic sort of Aave markets, servicing that debt and liquidations across chain into PMMs and solvers and across the Hyperliquid core order book, where there might be the best route to liquidity, that's not solved. Many projects say they've solved it, but it's not all the way solved. And there's all this sort of connectivity and things like that. We need that to be able to serve our users better. So that's an area that we are moving towards. And so you'll see a product release coming out soon called PawSwap, which services that. It services these swaps through routing through existing routers and aggregators and dexes and those sorts of things, so that we still use the tools that are out there, but we provide those best routes. We think we can do it in a very efficient and effective manner that has a leg up on other solutions for that. So when you look at HypurrFi, that's what I want to make clear. When I say debt servicing, that's not just hand wavy, trying to be ambiguous. Okay, a little bit, but it does mean that we have the optionality to build for the users in those gaps where we need to. And the card is a perfect example. There is a demand for this particular service, and particularly on Hyperliquid with lending positions instead of selling their hype. Nobody wants to sell their hype. You don't have enough hype. I don't have enough hype. I don't want to sell it, but I do want to spend against it because I got to pay my bills. I want to lease this car. I want to buy cat food, all the things that we're trying to do with that. So that's an example of where we're going, but there are many more examples of debt. If you look at traditional finance that runs on debt, the entire economy, global economy runs on debt, there's plenty of room on chain to service more different types of debt in those niches.
All right. So the next thing that I want to talk about is not necessarily a product, but a strategy that you guys are relying on. I'm assuming that since there are points, there will be a token at some point. But at the moment, US Treasuries are your backstop, right? And I'm not aware of other DeFi projects who are relying on US Treasuries as backstop, like they either buy back their own token and whatnot. Can you just walk us through, how and why did you decide to do this?
Yeah, so USBXL revenue buys treasuries. So that's just to provide a stabilizing force for the synthetic dollar itself. It allows for the speculation to eventually grow a solid solid backing. So the biggest thing is treasuries are a great vector for redemptions, which provide stability and throughput for your dollar. And so that's a big part of why treasuries. Now, all revenue doesn't flow to treasuries. And I wouldn't say that we're actually, fully backed. Our reserves that we have, are from the lending market revenue that we have right now, but whether or not we invest all or some or a portion of that into different assets is undetermined at this point in time.
And there's many other kinds of treasuries besides US treasuries. And we're exploring a whole bunch of really interesting stabilizing yield-bearing products. There's a ton of really cool stuff being built by teams that are in stealth. They're still raising, they're figuring out the things, but we're open to that. US Treasuries is a no-brainer. There's, Circle, USDC has USD, as treasury redemptions, and M0 is fundamentally a treasury redemption mechanism. And so there's a really established base of what has been working, and we can expand from there. So it's the same to us, it's the same as every product. Well, we go with what works and what makes sense. It's logical for users. The technical solutions are there. There's an easy flow for integrations and those sorts of things. And then we explore as we go on and find out, how does USDXL become an interesting piece? Now, you started your question a little bit about points and token, which is different than USDXL. USDXL is the synthetic dollar hybrid CDP thing for the debt rel servicing. But this other side, we're not talked about publicly, and we haven't really explored yet.
Okay, that's fair. I want to talk a little bit about composability and competition as well on Hyperliquid. I think I'll lump that into one. So there are various lending markets and CDP markets on Hyperliquid. So what is it that you guys are doing differently compared to those? There is a bit of composability as well. I have seen a lot of users, or I myself have done it. You borrow from one protocol and you use that as collateral somewhere else, borrow again against it, and loop that capital around using. So there is value in it. There is value in having multiple lending or CDP based protocols. I get that, but I just want you guys' view on it.
So you alluded to this earlier. TVL is not the only metric that lending protocols are interested in. And there are some other ones that we're very interested in, that we focus on, that we think we excel at, we know we excel at, and those have been our focus. And so when you look at how money moves and what protocols need to be sustainable and successful, revenue and fees are very, very important. So I'll let Andrew talk, because he's had philosophy about revenue and sustainability for a long time. That's why I joined this project in general. But for me, when I look across the competitive landscape, that's what really distinguishes us and what we care about. Why we provide things to users is so that this revenue flows.
Yeah. And so our whole thesis and everything we've built in the past, and why we even started what we're building right now, is around revenue capture and revenue redistribution and putting it into effect. And so a lot of people are, which you alluded to as well, are spending the revenue on buybacks. They're buying hype and they're making their own assistance fund, and every protocol is just let's just keep this hype flywheel going. My argument is I don't think the hype flywheel needs help. And I think that just a bad spending of revenue is not going to give you growth. Now, it's going to give you capital that you capture. And if you're, if hype continues to go up at the pace that it is, but it puts all of a sudden this massive pressure on if you want to actualize that value, you have to sell. So like you have all these protocols who have, like revenue for the sake of revenue is great. But if you're only putting the revenue into an asset that you don't control, that's not yours, and then you're going to have users that either going to want that asset, then the protocol itself is not capturing any value, not putting it to any work. So revenue is probably better used as an incentive to grow something, to facilitate and change your user behavior, which is the original thesis we had around cash flow. And so people say that cash is king. I actually believe cash flow is king. Your ability to have, consistent value over time, pushing or impinging upon a breakpoint of a user behavior, an ecosystem, whatever it may be, like eventually the dam will break. And so I think it's better to spend your revenue that you're producing on something that's actually going to move the needle and grow. And now it's funny because if you look at the size of these markets, a few $100,000 in incentives is not really going to influence or change the overall grand scheme of these markets. They're still large. And so it's probably a better tool to service for, user behavior, understanding growth facilitations, new campaigns, new initiatives. But also in the same vein, it could be really good to just have as an investment buffer or a vehicle that's growing for whatever that may be. We spent some of our revenue on the Hyperliquid Hackathon as, for a bounty. We look at this and say there are great ways to spend capital that could have maximum effect and impact. Maybe it's a seed investment in an emerging protocol that wants to come on chain, wants to build on top of HypurrFi. Maybe we write them a check for 25K. These are the kind of things that we think that revenue is better spent on because it has an order of magnitude function way higher than just buying more hype. We are a hype producing protocol. So to spend more of our revenue on acquiring the thing that we already produce as a result of open loans just seems like it's not very pragmatic.
The common DeFi playbook is you talk to OTC market makers and whales, and you rent some TVL for 3 months, 6 months, whatever your terms are. And you give them a great discount on points, and then they bring you $20 to $50 million to get that flywheel flow. That doesn't make any sense to us. That's not organic use. They're not real users. It's mercenary capital that is going to leave. They're farming your points or farming your token, and they're going to sell it. Some might hold it. Maybe that's a distribution venue. I think that's crazy, but maybe that'll happen. But for the most part, that's a use of your funds, of your available resources that is non-productive. And so when we think about that, when we see these playbooks, we try to think, well, how can our revenue, how can our resources be more productive? Thus far, we've never done a rented TVL deal. We don't do that. We don't participate. It's organic capital that has come in. They see the product, they come and they try it, they want to get leverage, they're real users. Do we sacrifice some top line TVL numbers? Definitely on that, right? But that's worth it for us on the other end of things that are more productive in the long run. And we've had amazing support from our investors, from our community, from our real users about that, is they like that because they know, okay, whatever is happening here, I'm the user. It's not some rented TVL user. And that's just one element of how protocols can spend their growth in ways that are questionable to long-term success, we think. But that's a way that we kind of focus and see okay, well, what can we do that maybe breaks the mold a little bit, even if it's a little bit of a harder pathway?
And I want to ask you, what are those KPIs and metrics that you guys think are more important than TVL for a lending protocol or for a debt servicing project?
Revenue, fees, user adoption. When we get people in the Telegram asking for specific features, that's actually a huge KPI for us. People are interacting with us and asking, how do I manage? Can you provide me this to manage my capital more efficiently? That's a win. That's a huge win for us. The feedback channel on our app goes directly to the team Slack. That's our favorite channel. Is, okay, what do the users actually want? What criticisms or suggestions do they have that they need? We get Telegram messages asking for isolated markets because now I understand a user's position and what they want to do. That's at this point, we've been live for 6 months. That's the feedback that we want. Those are our KPIs. Do we have active, engaged, real users who want to use our tools to further their finances? And revenue that comes from that and fees, fantastic. That's killer, of course, on top of that. But that's number one.
Yeah, our big philosophy on what we ship and how we ship is to find something that users like just enough to tell you how much they hate it.
All right. I think the last one. What happens if Aave deploys on HyperEVM? How does that impact you?
I don't think it truly changes our direction or need in the short form. We are on a different mission. We use a tool that looks like Aave, but we are not trying to be Aave. I would say it probably has a more severe impact on some of our direct competitors than on us.
We operated to the thesis that they are.
Yeah, exactly.
I don't know. But if my thesis is that Hyperliquid is the black hole and it's consuming everything and everyone is coming, I'm building so that when Aave comes, I'm ready.
Yeah.
If Uniswap decides to come, I'm ready. Why would they come? I don't know. Everybody's got their own reasons, but look at the track record, right? USDC announced, USDT is there, M0 is coming. Who else just announced? Balancer came. Like
Curve, Pendle, Morpho, Weather's coming. Like everybody's coming.
EtherFi.
You're right. EtherFi, EtherScan did it and even paid. Have EtherScan.com. Like, the dominoes are falling.
everybody's if they're not there already and they just haven't announced yet, right? Like, and so operate under that assumption and make sure you're building in the niches. So I'm not going directly head to head with Aave because it's a great offering, right? I love that product. I grew up using it. Like I was using it as a kid. But seriously, so that is how we think is let's assume they are. Let's assume everybody is. We know Wall Street is. We know the hedge funds are starting to buy hype. And so what are they going to want? They're going to want a variety of yields from known products and understanding. So let's build along the lines that they are coming. That's my assumption. And like Andrew said, it's like, well, we build the niches. We're building in these different veins that service debt, that can service debt on Aave, that can service debt through Euler or Morpho or whoever comes. Like that's where we want to be, is debt servicing broadly. Fill in the gaps. Be everywhere.
All right. This has been fantastic. Andrew and Andy, thank you so much for spending the time. This was fun.
Please follow us on X at HypurrFi, spelled like it is by my name. I'm Andy HyPhi, that you can find right there. And Androo Lloyd is the same. We're all on X and we shitpost regularly, bull post Hyperliquid and talk HypurrFi. The best place to hang out with us is our Telegram. It is DeFi chat, like supercharged, people who are active users who want to manage positions. So please check it out. And then of course, hypur.fi, check out the app, take a look. If you want to come in, you're not sure about Hyperliquid yet, we're working on getting a direct to bridge tool, might be live by the time this goes live, but you can always reach out to us on DMs on Twitter and in our Telegram as well. So thank you for having us. This is awesome. We're looking forward to talking more about HypurrFi and debt and Hyperliquid and what we're building.
Thank you so much for spending the time. This was fun.
Thanks for having us. It was a blast.